My name is Luci Ellis, and my economics teacher was Steve Dillon at University High School. And perhaps start with that story. Yes, I absolutely knew that economics was the thing for me. I too was quite focused on maths in my studies, but in the end I was always interested in human behaviour. And when I was a little bit younger, I thought, oh, maybe I'd become a psychologist. And I partly because I thought there was no maths in it, I decided, well, maybe economics instead. And there was the very interesting thing, you put your preferences in. And I remember, maybe it was one of my teachers saying, well, why, economics and commerce at University of Melbourne is your first preference, and economics law is your second preference. And but that doesn't make sense because it's harder to get into economics law. I said, yes, but they're my actual preferences. And so, sometimes pitching to your actual preferences is the right thing to do. And a number of years later, here I am. Michelle talked about the importance of the program and how great it is to see you all, see even more of you than last year. You might recall that last year we were sort of just really still opening up. Everyone was still like, am I allowed to cross the border? Oh, can I really come? We'd sort of unlearned the idea that we could move about. And so really, the last year or so has been a process of relearning what was possible prior to the pandemic. And there has been this big bounce back of activity. And of course, with that, there have been consequences. And that consequence has been inflation. The big story over the global economy in the last year and a bit has been how inflation has surged everywhere but China. A large part of that story is the pent-up demand after people opened up from the COVID lockdown. But supply does take a while to come back fully. So in the end, it's all about demand and supply. Demand bounced back faster than supply could manage. And of course, that issue around demand versus supply explains why you've seen a bit of a different pattern across different economies, because a large part of that demand has come from the extraordinary policy support that some countries put in through both fiscal and monetary policy. And to the extent that some put in more than others, you've seen more of a demand bounce back than others. And there's a lot of stories about pent-up savings and how that's supporting spending. But fundamentally, what the experience of the last year or so has shown is that policy, macroeconomic policy, really works. If you throw a lot of fiscal and monetary policy onto an economy, demand will surge, and once you run out of supply capacity, you will get inflation. Keynes was right. Now, you can see here, I've got headline and core. So headline is the CPI that everybody reports on and that you actually experience. But economists typically use various different measures to get a sense of the trend. And core is basically just excluding food and energy. And the reason we do that is because food and energy do tend to bounce around. You'll often get a spike in the price of petrol. It goes back down. One of the big stories last year, of course, was the $4 iceberg lettuce. And that went back down again. You have supply shocks in food and energy, and so an increase in prices doesn't necessarily presage ongoing inflation. And so to get a sense of the trend, it's common to focus more on the red line than the blue line, but of course both have gone up. Now, headline has increased more than core, and that's mostly because Russia invaded Ukraine. That affected the price of oil and gas, because Russia exports oil and gas, and that's also very important for fertiliser, which is important for food. And the Ukraine actually exports a lot of food. In fact, I know way more about the actually extremely diverse export base of Ukraine as a consequence of the last year and a bit. I did not know that they were really an important exporter of neon. So you get to learn a lot of stuff in these roles. But importantly, the consequence of that tragic invasion is that food and energy prices did, for a period of time, go up quite extraordinarily, particularly in Europe. That is now starting to roll over. It hasn't yet really started to roll over yet in Australia, and I'll get to the reason why we're a little bit different later when I come to talk about the Australian economy specifically. But so you saw, the other thing that went on in the core side is, core inflation's also gone up. That's partly because of the demand stimulus, but also because of supply disruptions. And that's still high. core inflation is still high, even though a lot of those supply disruptions really have unwound now. So there's a lot of different ways to look at supply disruptions. Here are just a few. Shipping costs went up. They're back down to where they were pre-pandemic, more or less. Various measures of supply chain pressures and how long it takes to get stuff. That's the delivery times one. Various sorts of input prices. We look at a range of different measures, but you can sort of see they all have the same shape. There was a big run up after everyone opened up from COVID. You had demand increasing with supply not yet able to catch up. Now some of those disruptions have resolved and those prices have rolled over. Again, we're not yet seeing that fully in Australia, and I'll explain why a little bit later. Similarly, after Russia invaded Ukraine, energy prices already had pushed up a bit because, again, of this supply-demand imbalance and the disruptions from COVID. But you can also see that things like thermal coal, crude oil, and particularly gas went up to extraordinary levels in the wake of the invasion, but most of that has rolled over again. And that's partly because, the cure for higher prices is higher prices. People don't want to spend that much money on heating their homes. They will find ways to economise. And the Europeans also found ways to, divert other sources of supply so that they weren't completely cut off. And you can see, obviously, your European gas prices did spike up higher than prices in the rest of the world, because of that segmented market. So all of the food and energy piece has really rolled back over again, but core inflation is still high because you've still got these lingering effects of strong demand, partly because of the extraordinary policy stimulus that was put in place during the COVID period, which has lagged effects, and there are ripple effects as a consequence of that. So that's really the situation for global inflation at the moment. Now, COVID lockdowns constrain services activity. So part of what we're seeing in services inflation, which is the main driver of core inflation now, is, again, because now people can go back to restaurants, and so everyone's going back to restaurants, but all the people who used to work in restaurants are now doing something else. And it's just, again, it's taking time for supply to revert back to where it had been. And so once the economy opened back up, you're seeing that services demand. And you can see this in various measures of services activity versus goods-related activity, such as manufacturing. What I'm showing here is a business survey that's common across the world. Basically, they ask a lot of companies, are things better than they were recently, or a few months ago, or are they worse? Are you expanding or contracting? And they put together sort of an index of people's responses. So it's sort of qualitative, but you can get this quantitative indication from those qualitative responses. And you can see that now that you can see the surge in the manufacturing sector during COVID, but that's now rolled over. Well, it's not surprising, partly because it already had that surge, and you only need to buy the exercise bike and set up your home office once. So that's done, and now what you've got is a surge in so services activity has been remarkably resilient, and that's the case even though right around the world policy has been tightened, interest rates are a lot higher than they were 2 years ago, and so forth. If you look at the last little while, you can just see a bit of a rolling over, but still expansionary. So the way these indices are constructed is above 50 sort of expansionary, still expansionary, but possibly rolling over. This is something, this is a graph I show frequently to other audiences because it is a great way of summarising developments in goods versus services. So that's really where we are. We're just sort of seeing how, just looking for the resilience of the services sector, because that's going to be really important for where inflation goes from here globally. We're also very mindful that part of the context for this strong inflation and resilient services activity is labour markets are really, really tight. Unemployment rates are very low right around the world. It's not just Australia. I mean, those of you who are aware, with unemployment at just a little above 3.5%, the last time unemployment was that low, I was in preschool. I think it's important to reflect on just what an extraordinary achievement after one of the biggest macroeconomic shocks the world has seen in many decades, and that we can come out of that actually with a stronger labour market, lower unemployment, lower long-term unemployment. Policy really works. The lagged effect of that stimulus, though, is still operating, and that's one of the reasons why right around the world, although a bit less tight, but there's still an awful lot of jobs available relative to the number of recorded unemployed. And in fact, for a number of these countries, there's a job for every unemployed person. It's just a matter of putting them all together. Maybe then, the job that's there is not the right person, so everybody has to sort of move around until, one opens up. But, that's a process. But, all of these economies, however you measure these things, extremely tight. Perhaps a little less so than it was a year ago, but still very, very tight. But as I mentioned, China's a bit of an exception here. And it's not just an exception because it was late to open up. It was the last to open up after COVID. And you can see the big spikes in retail sales tell you exactly when the lockdowns happened. And there was an initial bounce back in that first few months. But there's been a real loss of momentum since then. And when it's not just 1 month, it's sometimes hard to read through Chinese New Year. China has a particular difficulty with seasonal adjustment. They're the sort of things that we actually, when you become a practical economist, it's not just about the theory. There's a lot of just pragmatic, how do you read the data? But we've now got 2 months of pretty soggy data for China. And a lot of people, including us, are sort of reading this as saying, well, actually, China's opening up hasn't had this boost. It's sort of lost a bit of momentum. And part of that is just the nature of the policy stimulus there, wasn't like it was here or in, say, the US, where you had a lot of money going to households and small businesses, and it was just a pure sort of transfer and income support. So in Australia, we managed to, I'll get to this later, but we sort of filled the income hole that was created by lockdowns, and that didn't really happen in China. And so, they're struggling with very high youth unemployment, even though broader unemployment measures have come down, and some of these very timely measures of activity are looking quite soft. Now, to the extent that some of this softness is in household services, such as dining out, which again, they weren't allowed to do, now they can, the spillovers to other economies are small. It's not part of their traded goods sector. But to the extent that is also in their construction sector, which is seeing particular weakness at the moment, their residential construction sector is very weak, that's got more implications in terms of, for example, demand for commodities. And I might just then turn now more to Australia. And so one of the things we look at, I showed the iron ore price earlier, is the consequences of commodities demand, particularly from China, for commodity prices and hence for the Australian economy, where our top 4 exports: iron ore, coal, natural gas, university education. So, the top 3 of those are things you can dig out of the ground, more or less, or, and pipe in and ship off to other countries rather than people coming here. And so commodity prices are a really important driver of demand for Australian exports, but also therefore demand for the Australian dollar in foreign exchange markets. And so you can see, although the Australian dollar, it's bobbled around, but we would characterise this as being broadly flat. It's wobbled around a range. And that's partly because we've seen this sort of drop-off in commodity prices in recent months as energy prices and also iron ore prices have moderated. And what's held the Australian dollar up is the fact that we have been raising interest rates, and so interest differentials, which are an sort of important way of measuring sort of asset demand for Australian assets relative to other economies, which is another important source of demand for the dollar. That's moved in the opposite direction. So the net of those has been roughly flat. And I think this is a really important point about monetary policy is, we talk about the transmission of monetary policy. And if you looked at the exchange rate graph and just said, oh, well, monetary policy is not doing anything. But it's compared to what? And understanding that had we not done that, the Australian dollar would be lower. And as you've all been teaching your students, that would mean more expensive import prices, and that would mean even more inflation. So the fact that we forestalled that and the dollar has done what it's done is actually an important part of the transmission mechanism of monetary policy. It's not obvious from the top part of this graph. It's certainly not obvious from what you read in the newspapers, which is all about the mortgages, but this is actually an important channel, and this is, and I'm sure, in your curricula, this is something you'll be teaching your students. So I'm going to turn now to the Australian inflation. I did show a version of it in the earlier graph, but we also have very high inflation. It has peaked. We expected it to peak in the December quarter, and that's actually what happened. It is notoriously difficult in the economics profession to call a turning point, let alone forecast one. I'm very grateful for the team. They got that one right, and we're expecting inflation to fall from here. But it is extremely high, particularly relative to, I mean, this is, this is my entire career actually. I joined the bank in 91. So I joined the bank in 91, and so just as that, that little, slide down in inflation during the early 90s recession. I did mention I'm from Melbourne, and 1991. Almost everybody who graduated our year, Timmy, either actually you'd be one of the few exceptions who didn't move interstate for their first job. The rest of us all had to move interstate. Oh, that was another trick, but yeah. Firstly, cohort effects are important. I'm still here, but secondly, throughout the entirety of that more than 30 years, inflation has been a lot lower than where we are now. So this is really quite an extraordinary phase of the inflation targeting period. This high inflation isn't just concentrated in a few categories. Yes, there's that food and energy story, but it is actually much more broadly based. I love this graph. It's so colourful, but it's also kind of disturbing because it shows you just how broadly based inflation is. Initially, through sort of early, late 2021 to early 2022, when we were first concerned, we could see things were starting to come up, but actually an awful lot of the increase in inflation was being driven by home building costs and fuel. But as time went on, you could see it get broader and broader, and in fact, sort of, about 2/3, close to 3/4 of all categories within the CPI are running more than 3% now. We've got very high inflation across a very broad range of categories. And here's just a selection of them. And I picked these ones because, these are the basics. It's not just sort of going on overseas holidays or things that you can decide not to do. It's your grocery bill. It's rent. It's your electricity bill. And it's household services. Okay, you do, we did go without haircuts during COVID, but there's some really basic household services that you need. And so these are all pretty basic things. And this is really squeezing people's budgets. It's not something that's easy for people to just, reallocate their expenditure around. And there's some, important stories around this. Food still high, despite the fact that the flood effect has actually already gone through. The $4 lettuce is no longer $4. But there's all sorts of non-fresh, sort of packaged food, dairy, all sorts of other categories where price growth over the year to May was over 10%. And again, very unusual compared to the previous history. Rent, again, had been quite low. There was a bit of a dip down, particularly in Sydney and Melbourne during COVID, has really spiked, and given what's going on with population, we expect that to continue to rise. Utilities. A lot of other countries, they took a really big hit after Russia invaded Ukraine in terms of their energy prices, but that's now rolling over there. The way our electricity market is structured, you probably all saw it in your bills this month. July 1 is when all the household bills reprice, and almost, you're all nodding because you've all had these big price increases. So we knew that was coming. That's something we were able to forecast. A lot of things you can't forecast, but that was one we could see coming. But there's just some of the things that have already happened elsewhere and washed through are still to come in Australia, and this is providing more impetus to inflation for longer here. And so, institutions matter. And in reading what's going on in economy, comparing across different economies is important. But at the same time, you've got very country-specific components that you need to be aware of, and that's where a deep understanding of the detail is important. So while some of that inflation does still relate to supply disruptions, and the energy one is an example of that, and at some level, the fact that you can't just quickly build a whole lot of apartments is another part of it. It's also because of strong demand in the economy. The Australian economy is operating at a high level of capacity. So even if growth is slow, the level is high. And so one really fundamental thing I hope that you're conveying to your students is levels and changes are two things. You have to keep track of both. And that's quite important, because sometimes you say, oh, well, growth is really slow. And it's like, well, it is. But as I mentioned, unemployment is 3.5%, just over 3.6% in the current month. This is going to be videoed for posterity, so roughly 3.5. Don't get too hung up about this month's figures. They bounce around, but you can see unemployment's very low relative to, this goes back since, to the early 60s, right? So, there's very few people who remember all, that early period. So unemployment's low. Underemployment is also low. There was a lot of discussion pre-COVID, oh yes, well unemployment's low, but there's all these people who want more work who are underemployed. Well, that's also no longer as operative as it was. And even long-term unemployment has come down. So these are all things that we're very mindful. It's a tight labour market, and that's a good thing. That's been really good for a lot of people who are getting opportunities that they might not otherwise have. And in particular, they're getting full-time jobs. It turns out that all of the increase in employment, the very big increase in employment we've seen since the beginning of COVID, has been in full-time jobs, or full-time working. It may be that some of those people are working 2 jobs. There's a little bit more working 2 jobs than there used to be, but people are able to get the hours they want. And so fewer people are reporting that they would like more hours, and there's a lot more sort of full-time, stable roles available because the labour market's tight. That's really important. Now, because we've got a tight labour market, a lot more people in jobs, a lot more people working more hours, and of course, there has been some wages growth as well, that has really boosted growth in total income from labour. And that's part of it. So we're now coming to the national accounts, and there's a thing called compensation of employees or labour income, and that's the red bit on this graph. This is an updated version of a graph we had in the Statement on Monetary Policy in May. Over the year to the March quarter, compensation of employees grew 11%. And you can see, relative to a run of history, and I could take this back if I wanted to make the graph a bit messier, you can see just how strong that is. There's lots and lots of income coming from employment. That's great. But inflation is taking away more than all of that. And so if you focus on the 2 blue bits, the dark blue bit is the direct effect of going from nominal to real. And again, if your students leave your care knowing about levels versus changes and nominal versus reals, we have made a lot of progress. So I implore you to make sure they have that particular distinction nailed. But inflation is taking away more, almost all of that labour income growth. There's another element to that though, and that's the light blue bar, which is tax, bracket creep. So strong income growth also means a strong tax take, and in fact the share of tax in income is rising because of bracket creep. So that's that's part of the automatic stabilisers. It's one of the things that actually helps us deal with the inflation that we're seeing, but it does mean that the direct and indirect effects of high inflation are the thing that's really hitting household budgets at the moment. Well, what are we doing? Well, we're doing the gold bit. It's a lot smaller. Now, that's a net. Yes, people who have debt are paying more in interest, but people who have deposits are getting more interest income. And when you net the 2 together, it's actually not that big. And this is a really important point, and it's a point you'll hear us making quite a bit at the moment, that a lot of what we do is fundamentally distributional. If I were to break out that gold bit into a payments piece and a receipts piece, both have gone up a lot, but they're different people primarily. And so what a large part of the transmission mechanism of monetary policy is that the people who are getting the income tend to spend less out of every dollar, the easy way to explain a marginal propensity to consume, than the people who are losing net income because they're paying more in interest on their debt. So that's a really important point. And again, understanding how the policy transmission works, and that there's more to it than just the people with mortgages, is actually it's a very important part, and it's a very distributional part, and it does mean that there are many people who are really bearing the brunt of that, but there's a whole lot of other people who are really bearing the brunt of inflation. Now, I just want to come back to this levels versus changes point, because as you know, during COVID, there were a lot of things we weren't allowed to do. And once we were allowed to do them, we started doing them again. And you can see that particularly in services. Services consumption per capita went down a lot. Goods went up because, instead of going to the gym, you bought the exercise bike or whatever it was that you did. And so you can see it spiked down and then it's come back up. And the really interesting thing is other than overseas holidays, where there still is a bit of a shortfall, services consumption domestically has actually gone back to the prior trend. And this is the point of, even though you can tell by the way that the line is rolled over, growth in consumption is really slow, but we've got back to that prior trend. Levels versus changes, really important. And so we're back to that. But of course, growth per capita, this is just services consumption, but growth per capita is really slow. And so you can see that if you then scale up to the whole of the economy with GDP. Population growth has bounced back now that the borders are open. GDP per capita has been pretty weak because we got back to that trend and now we're just sort of there. But of course, nominal GDP, again, nominal versus real, nominal GDP is growing really quickly. And thinking through, there are certain things that are nominal, like debt, and there are certain things that are real, like people's experience of their consumption. And so this really shows you just how important this run-up in inflation has been for people's lived experience at a time when nominal GDP is actually growing really quickly. I'm going to also focus on a few other areas that have been a bit weak as a consequence of sort of having bounced back or because of supply issues. Another area that has been weak in growth rate terms is dwelling investment. So building of new homes and renovation work on existing ones. And so you can see the total line in black at the top, where you've got alterations and additions, or when you hear someone saying alts and ads, you know that they've been watching the economy for a long time, and then detached and higher density. And I think the stories about policy are really important here. So if you look at the detached piece, there is a bit of a run up in both alts and ads and detached during the COVID period, partly because interest rates were low, but also because of the stimulus provided by home builder. So there was an incentive to bring forward some of the building work you might ordinarily do. But there hasn't been as much of a run up from that as you might have thought, given how many homes were approved to be built under home builder, because this is one area where there have been very significant capacity constraints. The construction industry is highly constrained. Initially, that was mostly about materials. You couldn't get the tiles and the stuff. The supply chains were degraded. Quite a lot of building materials come from overseas, and the supply chains were degraded, and you just weren't getting things in. And of course, as anyone who's done a renovation knows, it's like, you can't put the floor in until you put the walls up, right? So if you can't get the bricks or whatever you're building the walls out of, you're waiting. And so the times taken to build houses at the moment have blown out. It used to take about 7 months on average to build a detached house. That's blown out to 12 or more months, even more in Western Australia. So there's been this real supply constraint, and that's slowing down the ability of the industry to run down that backlog of work, and it's also keeping the price of new building very high, and it is one of the components of inflation I showed you earlier in the very colourful graph. And as you can see, because of the way home builder was structured, you saw a lot more of that in detached than in apartments. There had been an apartment building boom in the years prior to COVID, and that's sort of done. And again, you have these sort of lumps of activity, and then they're worked off. But yeah, you in growth rate terms, and even in levels, when you consider how much stimulus and how low interest rates had been, once you hit supply capacity, that just limits your ability to keep growing. But the level is still really high. So again, that's a pretty important point. And to the extent that it's sort of hard to build a new home, maybe buying one that already exists is sort of more attractive. Are you really going to want to buy a house and land package if you don't know when you're going to get the house, and maybe your builder's going to go bust? So that is one of the things that seems to be contributing to the turnaround in established housing prices since the beginning of this year. It's sort of just been in the last few months, since about February. This started turning around. And to be honest, that was a lot sooner than we would have thought, given that we are raising interest rates, and normally, a higher discount rate has an effect on asset prices, and this is one of the other channels of transmission. But it's something we're seeing right around the world. So it's not just about, the difficulties building homes here, which is a bit of an Australian-specific story. It's actually something we're seeing across a range of economies, and it seems to be partly to do with population growth. The reopening of the borders, there's been a very rapid restoration back to the prior population trend, and perhaps even a little more. And one of the things we've discovered is actually, even though other countries didn't have quite the extent of border controls that we did, or quite the sort of length of border closures that we did, there's a lot of countries where you had that dip in population growth and now coming back with a vengeance. And so places like Canada, even the US a bit, the UK, you're just seeing, migration patterns are re-establishing themselves. And I think if there's one sort of really broad thing I take away from this is, the heat of the pandemic may be over, but there are ripple effects. When you have stocks and flows, that's another really important concept to get in people's minds. Levels changes, stocks, flows, nominals, reals, all really important. And the consequence of having stock flow dynamics and responses to one thing and then a response to that, you get these ripple effects. So right around the world, we're seeing housing prices start to come back up again, even though we're tightening monetary policy right around the world, is because you've got these population flows in those countries. So oftentimes the behavioural responses will absorb more than all of the policy response, and so we saw that also with rents. Initially, rents were very weak during COVID because the population growth slowed. A lot of people went back. A lot of students and other people on temporary visas went home. No one else was coming in. Population growth went down to very low levels. You would have thought, particularly with home builder, that would mean you would have a lot more vacancies in the rental market, that there'd be a lot of empty homes. But no, the average size of households went down. So the fact that rents were a bit lower meant that people could afford a bigger place. And I suspect there was an awful, a bit of people looking around at their 5 flatmates and saying, I don't want to be locked down with you next time. I want to be locked down with the one I love. Or maybe it was just, I need more, now I'm working from home, I don't want to be working around the dining table with my 5 flatmates. Actually, I need more space because I need a home office now. And so there's been, we think there's been a bit of a level shift in people's demand for household services per household. And as a consequence of that, we've seen this decline in average household size. Now that is starting to reverse, partly because as people, new migrants arrive back, students do tend to live in big households, so there's probably a little bit of an effect there. But also people are now saying, oh, actually it's expensive to rent now, and maybe I can't afford to make that choice anymore, so maybe I do have to live with 5 flatmates again. So, you are seeing those behavioural responses, and that's part of the story. But those inframarginal responses to the prices that people face are really important to keep track of, and that average household size thing is something we didn't really know, and in fact it's only recently we've realised that we can track it using labour force survey. There's a bulletin article about this in the March issue. It's actually kind of cool that we were able to do that. But these are the things that have been, all these cross-cutting effects on the housing market. And so it's right around the world we're seeing this unexpectedly early recovery in housing prices after the decline that was driven by the tightening in policy. Now, through all of this, because there's been this bounce back in demand, businesses have been reporting that business conditions are a bit above average. That is now slowing and is starting to, don't get too excited about the difference between the different surveys. Again, they're the sort of, practical things like seasonal adjustment you have to learn if you do this for a living. But the broad story here is, households are feeling the squeeze on their budgets because of inflation, but firms have a lot of work on. So consumer sentiment's really low, but businesses are still saying actually things have been pretty good. We're starting to hear from retailers and a few other parts of the industry, actually things are now starting to slow. But you'd expect that. We've tightened policy a lot and the level of output is very high. So we'd expect to start hearing that. So you can see it's turned down more recently. And it's become more consistent with that more moderate, even though they had a lot of work on, conditions were strong, but business confidence was coming down. So that's sort of where we're at. We've got this very high level of operation of the economy. Price inflation is still way too high. And the board is determined to get inflation down. And some of that will happen anyway as supply constraints resolve, but not enough of it. And so getting a better balance between supply and demand is important. And the board is determined to return inflation to our 2 to 3% target within reasonable time. And it will do what's needed to achieve that. Certainly, initially, we just needed, we no longer needed rates at emergency levels the way we had them during the peak of the pandemic. So a lot of that is actually a reversion to normal, and we had to move very fast to do that. It became apparent very quickly that emergency rate support was no longer appropriate. We've now got back to something that is actually leaning against the economy to some extent. And so what happens from here really depends on the data flow. And we are forecasting that inflation will come down further from here, and that we'll get to about 3% by mid-2025. It is going to take a while because of that high level of operation of the economy. Whether further is needed will really depend on the data, and that's really the question that the board is grappling with each month, and that the policies that they're grappling with, and the sort of questions they're asking of the team.